Hello and welcome to the Baby Giants Investing Podcast. Join us as we chat about the weird and wild world of small cap investing, all while searching for the precious few fast-growing businesses that have a shot at becoming industry giants.
This podcast is for entertainment purposes only and should not be relied upon as the basis for investment decisions. Podcast guests and their clients may maintain positions in the securities discussed in this podcast.
We're live. All right,
Hello.
We're live and half dead. Claude's a bit sick. I'm recovered, I think, mostly.
I have COVID again.
Claude's got the COVID.
Feeling great. Thanks for asking.
Andrew's feeling great.
And you always look young, Andrew. I was in my delirium fever dreams. I was actually remembering when we did the City to Surf together and how I only beat you by 30 seconds. And then I'm like, oh, but he's 10 years older than me.
Didn't we did a 5K together in Berkshire, didn't we, Andrew?
Yeah.
I feel like that might have been a wake up call for you to get in shape.
Yeah, I didn't.
You weren't bad. It was just you weren't having fun.
There's a picture I've got of you and me, and you're running, you got a big smile on your face, and I'm there trying to smile, looking like a beetroot that's just been baked in the oven for a while. It was not when you sort of see someone smile, but behind that smile is pain. That was me.
But then you got into shape again, and there you go. It's just been
and then I got out of shape again. So it's a cycle.
Okay.
Everything's
it's good. You never want to just be there all the time, or else it's just boring.
Well, I've got some good news to kick off. Paxlovid works pretty well. It doesn't work permanently, you can bounce back after it. But whilst you're taking the Paxlovid, it makes you feel a lot better. So
same can be said of heroin, though, right?
Yeah, I think it's a bit better for you, though.
Yeah, I did see some more developments on the AIDS front.
Oh, yeah?
Yeah, a few people have been cured through bone marrow transplants. I've got to fact check this, though. I saw something on Twitter, and I think it might be slightly older news, but I'm throwing it out.
I'll take the lead on good news, and okay. You know what that means. So great news for everybody who's worried about, home prices. The independent teals, bless their heart, have decided to have a people's forum about home prices.
I saw that, man. The responses were great. It was we should have a representative from every electorate that gets through and puts forward the views of the community. And isn't that
great? We can all rest assured now our children are going to have somewhere to live because the teals are going to have a people's assembly.
Oh, man.
That's definitely going to solve it. Much better than building new apartments.
One of the best takes I've really had on all of this is just from my 13-year-old son. And it's Dad, they always keep talking about affordability. Doesn't that just mean prices have to go down? It's you would think so, son. But apparently we want more affordable housing, but without prices going down. That's the one thing that cannot happen. We can't let prices go down, but we really want things to be more affordable. How does that work? It's son, I cannot tell you. I do not know. You've also got, one of the things that's important to understand there is the teals largely come from seats where there is a disproportionate
people own three houses.
Yeah. So I think they kind of rode some success on some sort of environmental groundswell that's sort of there. People are sort of happy to back. But when you sort of start saying, actually, I'm going to start running hard.
Because rich people care about the environment more.
Yeah. Yep. But they also care a lot about their investment properties.
Yeah. That's a double-edged sword.
It's going to be a harder thing.
The way it works is if you're in a teal electorate, you need to have one house to live in, one holiday house, and then one spare investment property for each of your children.
Mm. Yeah, that makes
sense.
The
Australian way.
Andrew, did you have some other good news? We were chatting before an AIDS breakthrough.
I talked about. I mentioned. I really got to walk that back a little bit here. I don't want to be shooting off things. I glanced at on Twitter, and now that's. Okay. I don't want to do a Joe Rogan. Let's just put it that way. I was some guy told me this, and therefore it's now true.
Let's get prepared if we're going to take on the podcast king. Cool. Okay, I got something else. What else do I have? There was some good news on. Fungi may offer jaw-dropping solution to climate change. There's some new research out from a university's biology department suggesting that fungi store up to 36% of annual carbon emissions and had been not properly accounted for before. So both good news in that it's happening and could be good news if we develop it into a way to, store more carbon using magical super fungi. So it's kind of
fungi is just so amazing. It's one of the domains of it is so incredible as to what
and quite poorly understood, I guess. They didn't seem to know this until just now. So it
is. Oh man, there's so much to say about fungi. I'm a big fan Big fan of
Big
it.
fan of fungi. Cool. Well,
Yeah.
but pull it together. We can have a fungi special on the next pod, maybe. There's a bunch of other stuff. Oh, one other thing that I thought was interesting topic for the pod. It's been discussed on Twitter that we could now engineer. There's a particular type of mosquito. They're only like 1% to 2% of all mosquitoes that cause every human death from mosquitoes. Basically, they're the ones that carry all of the diseases that can kill us. And mosquitoes are basically the biggest cause of death in human history, and there's potential that we could, well, we have the technology to eliminate them through a simple bit of genetic engineering.
Oh, you're talking about a gene drive, are you?
Yeah, I believe so. Go on if
Yep.
you want to microbiology explain it a bit more.
I think we may have mentioned this in an earlier episode, but it's I'm gonna do a Claude here and go off half cocked because I'm not.
Do not make that doing a Claude.
It has officially entered the lexicon.
Man, you really clawed this one up. All right. Well, the idea was basically, would you push the button? Is what I was going to ask you, because I just seen that come through that you could push the button.
So basically a gene drive, he says, thanks to the miracle of the internet to make you save face, is that you can use a genetic engineering process that propagates a particular suite of genes throughout a proper population. So you can basically sort of outbreed the bad ones and let the good ones have a more effective edge there. And because you can't get, I mean, actually, you got to be, I mean, this is like, oh, we've got all these cane beetles. Let's introduce a cane toad that will eat them. So there's like very direct lines you can draw between A plus B will equal C, but then there's all the unintended consequences. So if I could push a button that would kill all mosquitoes, I'd want to think about that very carefully before I did, because there's the second, third, fourth order effects that I might not be aware, probably I'm not aware of.
Yeah, that was kind of the debate going on. I'd lean towards pushing it. There was a lot of people who's like, never do that because we could get it wrong. But I feel like just because we've got some stuff wrong in our past doesn't mean that we couldn't. Because there's other stuff we've eliminated, like, was it polio and like, other things that aren't particularly nice to humans. We've been fine eliminating them.
But have we ever been okay like eliminating an animal by introducing another animal? Isn't that always a recipe for disaster?
It has historically. I can't think of anywhere it's gone really well. Yeah, but this one's not introducing another animal, I guess. But yeah, the idea would be other mosquitoes would take up their place. All right, let's move on. Let's move on to some other more fresh news. Probably not necessarily good news. Where should we start? We've got a bit of, it's kind of a quieter time at the moment in between just before reporting season, but we've got a bit of news coming out from retailers. Maybe we could start there in like a general economic check-in. So the headline, something that caught my eye was David Jones's kind of, I guess, leaked information that, some journalists got hold of how much David Jones's retail sales were down in different areas. So I guess these journalists got a hold of a spreadsheet. One particular store in East Melbourne, sales were down 38%. But in general, across a wide range of areas, they're down sort of, 15, 20% in a lot of their stores. Yeah, and just kind of like a general double-digit slowdown. I think it's kind of, there's a few things going on with David Jones, but it seems like it's more tied to like older consumers who are, baby boomers making up less of spending. There's just a shift away from these big stores to online, blah, blah, blah. But yeah, it does seem like also a bit of a canary in the coal mine to a degree for at least that type of anchor tenant. If you need a lot of foot traffic to make sales, maybe that's not so good. And at the same time, we also had an update from Best and Less, which is a publicly listed company that is basically, what would you say, like bargain clothing for kids is primarily, it's like bread and butter.
Yep.
And that had sales down as well. So
currently in the process of a takeover.
Yes, currently been taken over by Brett Blundy, the legend and the best retailer in Australia, is currently doing a takeover. So the shares didn't actually move that much as a result. But yeah, it seems like it's not a pretty picture out there. I don't know if you guys had any thoughts on the general retail malaise.
Sales fell 13.2% in the past 5 weeks. It's a big fall. And what's interesting, I mean, DJ's is probably sort of, at least tries to market itself as a bit more upmarket kind of stuff. So on the discretionary spending, it's probably, I mean, the magnitude of those falls were eye-watering. But, if anyone who's had kids, and you need a new jumpsuit because they keep growing, and this is sort of like that and Kmart kind of stuff, right? Like it's sort of like the real value end of the spectrum, and they're having to push through all kinds of discounts right down on some of their inventory. I think it's kind of a different, there's one thing if I'm sort of holding off buying my new $4,000 espresso machine, but it's just sort of like I'm actually slowing down on functional kids wear. It's a little bit of a different flavor, and I think we made mention before. It's always smart to sound bearish, and there's always things you can point to that sort of like are a little bit scary. But it's hard to think that a lot of people aren't doing it tough. when the biggest source of expenditure for a very significant number of people is mortgage or rent. Those things are going through the roof. There's massive inflationary sort of pressures and everything that sort of goes along with it. Now we're seeing it being very much playing out in the retail kind of space. Yield curves are inverted. The RBA has negative equity. I don't know. It seems a little bit scary. If you guys can help me feel a bit more optimistic, I'd welcome it.
What do you reckon, Claude? You've been thinking there's no kind of recession. We've been debating that one.
Well, I mean, obviously, a year ago, I thought there was going to be a recession. And now I still think there's a good chance of it. I just think that it's not as likely. In 8 days, we get the new job vacancies numbers, which obviously the ABS releases these things quite a long time after they apply. So that wouldn't pick up on anything that's going on now, but I'm still interested. But for those wondering, job vacancies are at job advertisements are at historical highs. Unemployment remains at historical lows. Now, I'm not saying that means it's economic smooth sailing. Far from it. If inflation runs ahead of wage growth, then the average person gets poorer and our living standards go down. And I do think that's going to happen. I do think we would definitely have a per capita recession. But the government's plan, which is agreed to by both major parties and even the Greens, everybody seems to have a consensus that we just use immigration to bolster the economy. And it will work. It will keep Australia growing if we do that. But of course, it creates this terrible problem with housing. So all in all, to me, it's all a negative for the standard of living in Australia. But in terms of do we actually get a technical recession, maybe we can escape it. And if we do have it, maybe just by letting people in, you keep the economy pumping. Now, that's terrible for people on the margins because if you don't have enough housing and shelter for everyone, then somebody becomes in real distress. And so I'm not saying that that's necessarily the best way to manage the economy, but I do think that seems to be what there's no even discussion that we shouldn't ramp immigration.
I agree.
I think it's got to do with the fact that the conservative side of politics like population growth because it means, more demand for all the services that your companies that you own shares in, etc., create, and more demand for the property that the wealthy people already own. So it's generally good for the people that are already it's not too bad for the people that are already wealthy who own the productive assets. And the left side of politics, who you might have in another world been more concerned about the actual living standards of the people that are less well off, they love immigration because they think it's racist not to love immigration. So everyone loves immigration. And I personally obviously it works for me financially, and also I welcome people from other countries. Obviously everyone, not everyone, but most of the country comes from immigration eventually. So I have no philosophical...
I think it's 50% of people have at least one parent born overseas, as of now.
Yeah, but except for the 2% that are, or even less, that are just Indigenous, I don't think there are many people who are purely Indigenous Australians.
Oh, 100%. Yeah, absolutely. And immigration is a wonderful thing. It's always, I think people are a little bit nervous of talking about it because it does, all the xenophobes talk about it for the wrong reasons. But I think you can have a sensible conversation.
The anti-immigration people have done the work, they've done the most service to immigration in this country, because the people who are loudly anti-immigration are also loudly racist. Now, I'm not saying all people who are anti-immigration are racist. I'm definitely not saying that. But the people that are loudest are like that.
It's just more that immigration should be matched to the infrastructure that is available. So the great thing about immigration is that you can sort of choose who you bring in. So we can bring in people who are high skills, people who are bringing a bit of capital in with them. This is a fantastic thing. I mean, it makes us a stronger society, a more productive. So I'm all for immigration, but I think it's probably pretty dumb to just welcome. I think what Matt Barry say recently, we welcome a Canberra-sized population every year, and we already don't have enough housing and services. So can we at least match those two things?
Matt Barry is a perfect example of why I just think that we're going to ram immigration, because he's some guy that has a loud opinion on a lot of things, and he's against immigration, but he's also retweeting Russia Today and stuff like that. So I'm going to take anything he says with it. Oh, default, I'm going to take the other side of that. He loves to give advice on everybody, or here's how you should run the country. I mean, have you seen the freelancer share price recently? Anybody who backed Matt Barry with their own money is nursing some sores. So yeah. No.
Yeah, I think I've actually had this exact conversation recently where it's unfortunate because people who you may disagree with in other domains can still make valid points in this domain. And, so it's sort of like you could get the most obtuse person that you can possibly imagine, but they can still say something that is true. So I don't think you want to sort of point to someone and say we should listen to him or her just for the sake of it. And I think you do need to sort of question their reasoning when other areas have sort of, it seems a bit whatever. But when it comes to a lot, not everything, but a lot of the stuff he says on housing, I'm a strong agree.
Yeah, and look, I agreed with some of the stuff he said about he was very anti-lockdowns in Sydney, which I also agreed with.
And the lockout laws. He doesn't like to hear anything interfering with his partying after midnight in Sydney.
I've invited him. He's coming on to Strawman for a chat. So I'm really looking forward to the chat. Honestly,
Can I hop on and ask him some college questions?
Look, any reasonably framed question, I'm always happy to ask. I don't want to start a fight with anyone.
He would be happy for a fight, though. I'm sure he's not he probably
okay. So shall we do some retailers though? Just run through some of the retail smashings that have happened recently. But City Chic is probably the biggest retail blow up that we've seen in a while. That's retailing clothes. Universal Store, another one that I think is like clothes and apparel. Feeling the pain. City Chic feeling the pain. Best and Less feeling the pain. What have these guys got all in common? They're all sort of just selling the things. What I was looking at during the week was some stuff from CBA that basically purports to...
So CBA card spending, was that the one, Claude?
Yes, that's the one. Did you guys see that?
I did. I was going to ask you, is that credit card or is it debit card or just say like any form of tap?
Debit card. Yeah, I think it's debit card.
Okay.
But what I was seeing with that I found interesting is that food spending remains strong. Recreation spending, it's not going up as quickly as food, which is obviously impacted by inflation and non-discretionary, but it's still going up. But clothing has really taken a hit and goods have taken a hit. Transport is flattening out and general retail is flattening out at best, I think is how you describe it. Eating out, still strong. Supermarkets, still going up. Oh, and then the things that are going up, the main thing that is going up is medical, right? So I think maybe finally my, philosophy of investing in healthcare might actually be, coming to the fore again because, that's just cost that's non-discretionary and food's non-discretionary. And what we're seeing is the more discretionary stuff now is coming down. I think what we can say is, things are really starting to turn down in terms of the economy. Now, how bad it's going to get, we already had a discussion about that. But yeah, I think that, the long-awaited, retail's going to hurt is actually here now.
What do you think, Matt?
Yeah, I think it's pretty clear retail's hurting. And I think you're right. There's certain sectors that aren't so far, but we'll see if that continues. As the other thing you were mentioning that Andrew shared was just the roll-off of mortgages. So we should see, a lot of the fixed rate mortgages start flowing through with higher rates. Yeah, and Andrew also being a bit bearish on property for a while, but another point you make is just how much of property investors are negatively geared, and basically whether we see that those people start to get a bit more hit potentially as well. Yeah, so I think there's all there. I guess the question is, how bad is it? How much of an effect? I think the point around immigration is really key because it's just such a big level relative to our population. If you think like 400,000 into 25 odd million, it's a bit over 1.5% of GDP basically, assuming those immigrants are about as productive as existing citizens, and probably some of them arguably might be more, I'm not sure. I think it's like a free hit for Australia. If you look at our level of immigration, basically because the US is so bad at doing immigration, skilled immigration, I just think Australia soaks up way more than it probably should globally, and it's an incredible benefit to the economy that we have it for so long. It does lead to some problems if you don't invest for the growth, like we haven't been building enough houses, obviously, but yeah, I think that just having that immigration is the biggest bull case for Australia over the medium to long term, particularly when we don't, like most of the world, we're not producing enough children. So our fertility rate is way below replacement. If it wasn't for immigration, every year we'd be facing that same effect we're talking about would be in reverse. We'd be facing this decline.
1.6%, I think, is the average number of kids per household. What did I say? Percent, sorry. 1.6.
1.6 per.
You need 2.1 to stand still. And for health reasons and the rest of it. But yeah, we're at 1.6. So we've actually been like below 2.1 for decades on existing citizens.
Yeah, correct. Which is like disastrous for the economy if that continues to roll through. That's basically what China's now facing. And yeah, we're getting this amazing freebie coming out of it.
China doesn't really do immigration though, so
that's it. That's part of why is they don't do immigration. It's like close to a monoculture with Han Chinese kind of dominating culturally and don't do immigration.
Well, look at Japan, right?
It'd also be hard. China couldn't import. There's just not enough people in the world for China to import 1.5% of its population every year. You know what I mean? Just like there's not enough migrants that want to move anywhere, let alone why would you move to a dictatorship?
Yeah. So. Anybody want to go to China? China looking for China. Anyone? No. All right. Okay. Well, we should do a proper full discussion of pronatalism sometime in the future, Matt, because I feel like we could really get into it.
Yeah, man. I'll prepare some notes.
Yeah.
It's very contrarian view. I think it's less contrarian now. Like I see more stats being shared on it. But yeah, anyway, something for a future.
There was a really good article on A Rich Life in the news section. Pronatalism is flourishing in Silicon Valley, which I don't control any of the news content.
It's on the cover of The Economist this week. It's the baby bust economy or something. So it's starting to get mainstream when The Economist is talking about it.
Actually, one of the pronatalist sort of people that Maddie, our author, wrote about was actually responded and like, oh, well, thanks for this respectful but critical sort of discussion. So I think it's an interesting discussion. Anyway, moving on from that. Look, I just wanted to throw in a company that we discussed before that is bucking that retail trend so far, and I thought maybe we could explore some of the reasons, whether we think it'll continue, etc., which is Cettire. I just run through a bunch of mostly bricks and mortar retailers that have been hit real hard just recently. And meanwhile, Cettire has come way off its hype peak, and it's come down and it's gotten completely smashed after COVID, as a lot of online retailers have basically had this cycle where they did really well in COVID and then everything opened up and then things have got harder. The cost per click of advertising has gone up massively, basically because the people that are searching for things online are not as high intent anymore. And there's more people, basically the number of clicks went down, so you had more competition for the existing clicks. They've taken that hit. The founders sold shares a few times, but now the share price is trending back up. You could argue that the results have definitely come back, have definitely improved. Now they are a big fan of sort of flimsy-flamsy adjusted EBITDA kind of stuff, so it's hard to really know. But definitely it looks like they've hit the brakes on some of that marketing spend. And so I just wonder, what are you guys thinking about Cettire now? Is this going to continue bucking the trend because, and I feel like this is the thesis that will get told, because it's luxury goods and Best and Less might be doing bad. And, Cettire is selling $1,000 shoes, so the people that want $1,000 shoes are still going just as well. What do you guys think about that?
I think it's hard, right? Because I'm actually, this is probably the value investor inside me. I actually think it's some of the more harder hit ones that are more interesting in a lot of ways, because what we're talking about here is not a secret. Like everyone knows it's super tough. And it's more a question of, do they survive? Is this purely cyclical? Does it come back? Will I buy a stock on a PE of 6 on a forward basis? Even though the company is not as good and have some of the attributes you talk about potentially with Cettire. I mean, look at Temple Webster. Temple Webster is on a PE of 88. Right? I'm just looking at Comsec. I think they use a blended past and future kind of thing. And
but another one. That's another one that it fits the discussion that I was just trying to say.
Yeah.
I'm glad you put it up, because that's come back up. It got down to $3.31 and now it's $5.22. Some of these online ones are moving in the opposite direction of the bricks and mortars.
It's interesting, isn't it? And I guess it's not so, like, if you were to say to me, which business would you rather own? I mean, there's some that are just, I think, more interesting than others. But everything has a price attached to it. So it's kind of like in this, I will probably regret this statement. And I'm certainly not doing anything with my own money to sort of, put my money where my mouth is. But I feel as though there's just too much in the price for some of these ones, because there's good reason to be more optimistic about them. But it's like, am I paying 88 times for an online retailer of furniture during a period where, well, to me at least, property looks a little bit iffy? Or would I rather pay 6 to 8 times for a discretionary, I don't know, like an Adairs or something like that, even though it's like the quality and growth outlook isn't perhaps nearly as good? I just feel as though one has a better return return potential from at least a medium-term investment standpoint.
Oh, so the value investor coming out today.
Yeah, so this is, I saw a great meme on Twitter. It was sort of like value investors finally having their day in the sun, and like there's a bus on a train track, and then like the train comes through with AI written on it. Actually, I was just going to say very quickly today, I was just looking at Temple and Webster's latest update. They're sort of saying, it looks like we're cycling through some very strong periods, but things are getting a little better. And then there's the second page is all about their AI update. And I'm like, oh my gosh, guys, come on. Like, is AI applicable to their business? Of course it is. What strategic competitive advantage does that give you over other retailers that can sort of use it to improve inventory management or sales and online conversions and the rest of it? I think this is where we're going to sort of see there's a real distinction for me to be made in something that does AI, I'm going way off topic here, does AI apply to you, or can it be applicable to your business? Yes. Can it be applicable in a way that is not accessible to others? Probably not. Back on point. What were you going to say?
Well, I think we would just put a pin in the retail one right now. I think the main thesis that I was getting at, the question that I'm trying to flesh out really is, are we just seeing a rotation back from the bricks and mortar guys on, low PEs, but with inventory issues and, all of these more capital intensive stuff? They've got stores, they've got inventory, they've got all these things that makes their business capital intensive, which is typically harder in inflation. I know that all the tech stuff has been absolutely killed lately, but if you look at the Warren Buffett letters from the 80s, when he'd just been through 10 years of high inflation, the conclusions, I can't remember the year now, but the conclusions in one of those letters is basically you just want to buy capital light business with pricing power. So maybe at least, even if they don't have that much pricing power, at least the online retailers are relatively capital light because they're kind of doing drop shipping stuff, certainly Cettire and Temple and Webster. So, if I had to pick, despite the PE ratios, I'd take the other bet. Now, that doesn't mean that I can't get sucked in by a value investment here or there. But the thing that gets me about the low PE investing is half the time when I buy a stock on like 10 times earnings, before I know it, it's trading on 7 times earnings.
Yeah, I know that feeling very well. Yes.
And then at least
it's so cheap. How can it get cheaper?
At least you get a dividend, right? Like sometimes the dividend saves you, but then it's like you hold for 3 years, you get your 6-7% dividend, and then it finally gets back to the price you bought it before, and you just sell it out of relief, and you have mild PTSD from it. And you might have actually got a decent return because you probably got a good fully franked dividend, probably a grossed up yield of 9% or something.
And you probably sold for the exact wrong reason, right? Because what typically happens if these cycles sort of continue to propagate is that, it turns out not only can the PE go from 10 to 7, it can go from 15 to 25, right? And I was just going to say, but we'll get into some small caps here, but I think the other thing I sort of want to even pan out beyond just the retail sector, I think it's interesting. This is the most unusual, despite all of the bearishness that is out there, markets are not that far away from record all-time highs, right? So everyone's saying, recession, inverted yield curves, this, that, and the other. And it really hasn't played out on the market at this point in time, which I find fascinating. I know Australia's a bit different because it's just like, there's the mining sector, which is doing a lot of heavy lifting, but do you guys not find that unusual?
Yeah, it's pretty weird.
Okay.
But I mean, I think there's a few things going on. One, we've mentioned everyone's been trained not to worry about anything bad because central banks bail everything out so quickly. I think that's part of it. I think we've relearned that lesson, and a whole new generation learned that lesson in March 2020. So I think there's an element of that. People are not that worried about it. Yeah, I don't know. I guess everyone thinks that they're going to cut rates soon as well. So yeah, it's a weird combo of things. I agree. It doesn't seem to make a lot of sense in some regards. But
I think a bit of it is a Tina phenomenon. There is no alternative. It's sort of like, this looks like a pretty crappy proposition on a standalone basis, but what else am I going to do in an environment of very aggressive inflation, and knowing, as to your point, that there could be a whole bunch of sort of stimulatory efforts. It's really interesting times.
Do you want to touch on environmental group, Andrew?
Just quickly, well, this is not going to be a deep dive, and I don't own shares, but EGL is the code. We spoke to Jason Dixon. Actually, he's one of the first interviews we did with Strawman, I want to say late 2021, about 8 months after he'd taken the reins of the business. So we caught up with him again recently. This is a business that name probably gives it away. It's focused on environmental stuff, but specifically they do a lot of engineering, anything sort of from like air purification, water pollution systems, bio-waste, gas turbines, these kinds of things. And it's interesting. Well, it's actually, first thing first, it's actually celebrating its 100 years since incorporation, right? This is a business used to be in the funeral parlor game, right? So it's had a bunch of, now it's couldn't be more different, right? So it's had a bunch of very aggressive pivots, been listed on the ASX since 1977. But I think they just had a bad run they just made some bad investment decisions. They took, like a lot of engineering companies, it's like it'd be so tempting just to win work that you'll take it at uneconomic rates or at rates where there's just no margin for sort of error there. And I feel as though Jason's brought quite a bit of discipline to the business. So they've got these nice they've got some more established units that are, after a period of heavy investment, I think it's really starting to sort of bear fruit. But they've got some other irons in the fire. I don't know if anyone's across the PFAS issue. These are these horrible particles that in everything just never break down. And I think 98% of humans around the planet have it in their bodies. They found it in penguins in Antarctica. Nasty stuff.
I think they had a problem with military using them in fire extinguishers around Port Stephens and stuff. And I think even a bunch of people have gotten sick from that.
That's horrible stuff, right? Horrible stuff. And so there's obviously, I shouldn't say obviously because the world is pretty mad at times, but thankfully there is a more bit of a focus on this and needing to sort of clean this up. They've developed some really interesting technology, which is more about very high volume throughput at lower concentrations than sort of like a military base will have very high sort of concentrations and spills where they can sort of process these things in much larger volumes. Really promising. First commercial plan up recently, a whole bunch of interest there. This is a story of, look, you don't want to invest purely on thematic tailwinds, but there are some really strong tailwinds blowing for this business. I think you've got a new management team in place, which is much more disciplined. They're demonstrating some really strong growth already. So it's sort of like, it's not just pie in the sky. By the way, they're a profitable company, right? And they're on track to grow pretty strongly. I don't own shares. So again, I'm not trying to pump my bags here, but yeah, that's the very quick shooting from the hip summary.
I mean, it sounds pretty interesting from what you laid out. Profitable, growing.
Yeah. I mean, it's a 70 something, 80 million maybe market cap company. So still relatively sort of small. PE, I should just look this up, but I want to say, I know PEs are horribly crude, but they are a nice, easy heuristic to sort of throw out there just to give people a bit of a benchmark. It's sort of around 38 times, so there is a bit of expectation that is in the price, but there is, I think, good potential. The other thing I should have mentioned too is the transition to renewables. You just can't do it quickly, right? You can't, is the reality of the matter. We need gas peaking plants. So they've got tech here that allows the efficiency of those to improve radically. The other thing you guys will like is that, now, we've got to be careful with the language here. I know you, Claude, have an issue with this, rightly so. There's a lot of companies like to throw out the word recurring revenue, but they would say 50% of their revenue is recurring in the sense that you sort of sell these units and then there's maintenance, upkeep, and parts that come with these fairly long-lived assets. And they tend to be very acyclical in the sense that the kind of customers, I mean, like if you're running a kind of operation, big industrial operation that requires this kind of stuff, it's sort of like you're maintaining it and using it no matter what the broader economy is, so long as you're in business. So yeah, it has a couple of nice characteristics.
Yeah, I've had a look at EGL from time to time because obviously, I would like to invest in a company that's helping make the environment safer, etc. They've done a capital raising at 20 cents recently to fund the acquisition of Airtight. It was a little bit of a, I guess, orange flag for me when I saw that the Airtight expected FY 2023 revenue was 18.2 million and normalized EBITDA of 1.8 million. So they're buying a company that has 10% EBITDA margins. Yeah, that to me.
So the argument there is that it significantly broadens their addressable market. So I think they increased that. Oh, geez, I should know this, but either the segment or the company, I think from 250 million to 400 million. Now, addressable markets are nice, right? Doesn't mean you're going to capture them, but it significantly broadens.
But if it's making 10% EBITDA margins, then it must be loss-making.
I think it's profitable. I think they said it's going to be earnings accretive. They have done others in the past, and they've been pretty
they did say it was supposed to be EPS accretion in FY 2024. So
yeah,
how does that work though? If it's 10% EBITDA margin, anyway.
I'm not sure. I'm just wanting to put. Look, I'm just like, what companies are you talking about? I was like, well, I spoke to these guys recently. I think the listeners like.
No, I think it's interesting.
Have a look at it, right? Is all I'll say. And I don't own shares, but there are some interesting dynamics at play in that sector. Fair warning. Massively illiquid, right? I'm looking at the screen today. One trade of $5,000 has gone through,
It's not that I think all low margin businesses are bad. It's just that I think that when a business is low margin, scale is quite important, because then that creates a quasi moat, you could say.
Oh, very much so a moat. Yes.
If you're large and still low margin, then it makes it it's more difficult for somebody to come in, because they'll be small and even lower margin. So they'll have to, make losses for a while.
And not just difficult, but unattractive. Like, of all the areas to deploy capital to, am I really going to deploy capital to something where if I'm successful, I'm going to get a 2% NPAT margin? I don't mind
low margin, but small and low margin for me is a bit scary. Anyway.
Yeah, you've got to, I think one of the key things, this is just a general rule, and this is where I think some very interesting opportunities come out, where you get those margins being squeezed by periods of heavy investment. And I think anyone, and all of us have, and I know a lot of our listeners have started a business, like you spend money up front and then the money comes hopefully later down the track, right? There's a question of what does quote unquote underlying look like if we get rid of all of our growth investments. Maybe it looks a little bit different. And more to the interesting point is, what's the return on investment from this capital that we've spent? Because that's foundations for future growth. And you get some, I think I mentioned LaserBond as an example of this recently, where it's sort of like the investor that doesn't dig very deep looks at it, goes, really small margin, not very profitable. There's no free cash flow. It's like, yeah, but where has that money been spent? What's the likelihood of the return on that? And how does that change things 2-3 years down the track? That is where opportunity can be found. Not will be found, because the investments might prove to be horrible, but can be found.
I mean, it's not terrible comparison with LaserBond in terms of them both sort of smaller capital intensive companies, but obviously with LaserBond, the EBITDA margins are a bit better there.
Do you want to do a quick take on Iress, Claude?
Yes. Well, I kind of want to hear your take on it. And then I had an idea for a new segment, which would be to just quickly run through some small cap or micro cap good news, because they're often, there's sometimes good news from these little companies that have basically no coverage. So I thought we could touch on some of that.
Yeah, man. Do you have any good news?
Okay, we can do that first and finish off with Iress. So that we'll do the babies and the giants. So yeah, I wanted to first talk about one that we had previously covered on A Rich Life. Actually, not me, Ben, quite a great writer there, one he owns. So just full disclosure, you can read the full article, but basically they upgraded guidance.
Who?
Vysarn, earnings update.
What's the code?
VYS. This is a little industrials water treatment company over in Western Australia. And there's a few reasons to be cautious of it, for sure. Definitely, I'm no massive bull on it, but it was good to see that they have upgraded their net profit before tax guidance to 6 to 6.5 million from the previous guidance of 5.1 million. So I know that there's a lot of readers that are not like, and listeners, I should say, that, obviously you like to keep a track of those companies that are having, some sort of upgrade cycle. So that was one to think about on the watch list. Next one I wanted to touch on is Austco, and I thought that
they had some great news recently.
This is animated, Andrew. Do you want to you give us the synopsis of the recent news?
I think it was Ausbiz or something, maybe last year, and they always, it's very hyperbolic. What's the best stock? Give us the tip for the. And I said, I think Austco looks really interesting, only because I just kind of thought I've really got to stop talking about the same three companies, right? So, but anyway, they won this $7.4 million contract to provide a Canadian healthcare company, their whiz-bang sort of solution. It's the largest in the company's history. They have had some real traction lately, again, after a period of heavy investment, which is rather interesting. So that doesn't mean that it's guaranteed from here, but as we've often remarked here, I think one of the real challenges with companies, particularly in the healthcare space, you make all this investment and then it takes so long to build momentum. But once a bit of momentum is built and there's very good quality reference sites there, the sales tend to come thicker and faster and at much lower cost. And hospitals around the world, you could say the same about Alcidion and others, but they're all trying to look to become far more efficient. They have underinvested in technology for a long, long time. I mean, I'm still blown away. I had some medicos just say recently they're still using fax machines and pages in many of these kinds of institutions. It's just so shameful. So I feel as though this is when you have a pretty competitive tender and a pretty big organization, and a relatively small Australian company sort of wins there. It's encouraging. Shares are up 30% on the back of this news. Oh, maybe at one point.
Do you own shares, by the way?
No, I don't. I don't know.
I thought you did.
I think I may have for a bit, and then it was more of an opportunity cost thing, and kind of shot myself in the foot there.
Yeah, no, I'm happy to see it go up. Like, I thought that it was undervalued for ages, but kind of lost. Well, it was just never a big high conviction position for me, basically. It was more just, it's the kind of specky small stuff that I quite like, but also don't really love writing about it and all of that kind of stuff, just because things can change quickly with these small companies. So I more prefer to just talk about them as interesting ideas rather than necessarily have super high conviction. But I still do think that this is very good news because it's the largest contract, and as a heuristic, that's one of my green flags. A largest new contract win is great to see, and already this is a turnaround that has really you would say that it's turned around the ship quite a lot. A profitable little company now. It's had some tough times, and now its share price is starting to reflect it. So good on the people that are holding, and also for the small cap investors out there. Obviously, this kind of stuff is high risk. It's not a software company. It has like 15% of its revenue is software. Again, Benjamin Sayers has done it right. It's his podcast today. He did a write-up, I think, for us at Rich Life ages ago. Not sure if that's open to the public or not, but either way, I think it's an interesting company to watch.
Oh, here you go. I put it on Strawman at 13 cents. 2021, July 2021, sold at 12.5 cents. I locked myself in a nice 7% loss and could add a 50% gain. Nice one, Andrew.
Lack of patience. I got hit by the same thing, mate. Anyway, so last one for today in the new microcap good news segment is a little company called EDU Holdings. And look, there's been a big, return to glory for general vocational education kind of stuff. Obviously, we have a shortage in certain fields, which these guys are focusing. This is a tiny little liquid microcap. Of course, it's not a safe investment. It is, this is by no means me saying, oh yeah, get on it kind of thing. But I just think it's good to note the good news, which is that these guys own a vocational education called Icon, and that this has got good, strong enrollments going up, basically. So that is interesting because this is a tiny, small, subscale business, but it's getting good growth now after having a tough time during COVID. So I think that that's interesting, and it was some microcap good news.
What do I want to say? I think we've made the point before, but I think of all the areas of disruption, areas are ripe for disruption. If you want to talk about AI, I think education is just so up there. And having my wife go through the process on the way to becoming a teacher at the moment just shows you how inefficient, backwards, and ridiculous the whole system is. And I just feel, as I've said before, when I can spin up an infinitely patient, all-knowing kind of tutor for very low cost. I mean, even if you ever been to brilliant.org or something, I mean, man, the stuff those guys are doing is just like the quality of education that is out there. I mean, it doesn't replace human tutors or anything like that, but it's just, I feel as though, and there might be certain niches within that where they're more protected than others, but I don't know. I feel as though they're sailing into the wind there. And maybe this is something that takes 5 to 10 years to play out, but I'm a bit nervous about the sector.
Yeah, I think that may be fair, but also it's just partly it's a box ticking exercise, right? It's like if you want to become a daycare center worker, you need to get a piece of paper that says that you've qualified, and that's what these guys are in the business of selling.
Yeah.
So it does
Yep,
it does have some elements that I would look for in a business. Like, it's kind of capital light. You've got a classroom. You're teaching some content. Once you've got all that, it's just, extra enrollment starts dropping down to the bottom line. So you could see a strong improvement. Obviously, this company is just some tiny little company that's not profitable. Nobody cares about it. Nobody's paying any attention to it. But this to me is starting to see an early sign that sometimes it might one day become a small little profitable company, and then at least some people will start paying attention to it.
Nice. Should we ramp with Iress on the big end of town?
Yeah, we've lacked your insights today, Matt, as you've
I've been cutting out a bit. The NBN outage is what's going on. So. And my phone apparently doesn't like staying on all the time.
What a great country we are.
Maybe give us a rundown, Claude, of Iress. I actually saw this was presented at the Morgan Stanley conference a bit over a week ago by Chris Cortis at Alliston. So I can talk to a couple of things he said, but maybe just give us a rundown of why it caught your eye.
Well, yeah, sure. I know that you've got that, Matt, and I know that once upon a time you liked this one as well, Andrew. So keen to hear what you think. But look, the story here, it's pretty simple.
Long time ago.
Yeah, so obviously everybody knows one of the things I do monitor is a bit of director buying. So we did have a little bit of director buying recently from Iress. On top of that, look, the story here seems to be broad strokes is it's a company that has been insufficiently focused on just the core parts of its business that where it might have a bit of a moat. As a result, there's been too much spending. It hasn't been focused on being as efficient as possible and maximizing free cash flow today. And as a result of that, yeah, it's been disappointing shareholders and not really trading at a very attractive multiple. Given that, you could argue that this is kind of a decent software company, right? And we know that a good growing software company can get a really high PE multiple, and there's probably some sentiment upside if they get things pumping along better. So for me, it's basically a bit of a turnaround story. Obviously, the market now is less interested in various growth initiatives and more interested in trying to, a lot of companies that have been cutting costs, and we've seen quite a few in particular software and tech companies cut costs, have seen a share price re-rate as a result of that. So I'm just wondering if, as Iress itself, focuses a little bit more on balancing profit and growth, if that could be good for both the actual earnings over the next couple of years, but then also having a little bit of a good impact on the sentiment as well. Not saying it's cheap. Obviously, it's a bit of a giant, but it's got deep embedded business-to-business software, and we all know that sometimes these business-to-business softwares, they really do have a big moat. There's high switching costs, etc. So there are parts of the business, at least, that are probably quite good. And if you bring a real efficiency to it and focus on the good parts, bring them to the fore, then you could have a couple of good years sort of turnaround or sort of matching the strategy to the market environment we're in right now.
Give us the bull case, Matt, and then I'll crap all over it.
No, it's pretty similar. It's basically what Claude's saying. I think a turnaround, if you applied the rule of 40, which he claimed to have just learned about a few months prior, then it looks like it could be pretty good. Yeah, it's a weird pitch. One line that I wrote down that stuck out was, if management don't execute, they will be shot. And that was the quote that I wrote down. So yeah. I guess the idea that they've got a chance to do a turnaround now, and yeah, some significant shareholders are probably putting a fair bit of pressure on them to make sure that turnaround happens. So yeah, I don't have too much more to say other than that it is very in the niches that it operates in. It's very sticky.
It's first order thinking, right? It's like there's near-term, short-term gains on offer, and you can make this look better over the next 2 years, and then suddenly it'll look like it's got good profit and even profit growth, and there's not much chance that's sustainable. But sometimes it's not a bad bet that the market will just extrapolate that, and then you get a moment where you get a good price.
Yeah. I guess, it's had a pretty woeful decade of just stagnation. So, and despite getting double-digit return on equities, there's obviously been some malinvestment along the way, right? I've always found this very curious. You look at Bloomberg, you look at Iress, you look at these financial data service providers, and you ask yourself, what's the moat here, right? In theory, this is publicly available information, be it just share prices, company financials, news sources. Like, I'm just aggregating that and putting it into a nice GUI, right? Like a graphic user interface. Definitely there's.
Did you find that with Strawman? Do you find data was quite freely available and you didn't have to sign in?
So you know the answer to that, right? And it's just sort of like the monopoly that is the ASX. Charges like a wounded bull. The regulations around it is the barriers to entry are so ridiculously high. And so I remember when I was more in the sort of startup scene and going along to all those waste of time sort of seminars full of people who'd never done anything successful in their life, telling you how to run a successful business. What am I trying to say? It never struck me as something that should earn any outsized profits in any free and open market, and that they do earn extremely good profits in that, because the switching costs are real. I get all of that. But in a world of increasingly commoditized data, and I can now, I think it is slowly getting easier. The only thing stopping that is by having this really arcane regulatory wrap around it. and that people will pay gazillions of dollars for a Bloomberg terminal, a ridiculous subscription for an Iress terminal. I'm getting publicly available information. You know what it's like, Claude. I'm sure you've looked at it as well, like putting share prices on your website. I mean, the amount of hoops and costs you have to sort of jump through. So, okay, great. You guys are on the other side of the fence. You're going to exploit that to the best of your ability. Good luck to you. But I feel as though if that goes, and maybe that'll never go, and therefore there's the investment case. But if that ever does go, I feel as though they what's the secret sauce that you're doing that, a couple of kids in their basement can't spin up relatively quickly and easily? It's why everyone was scraping data back in the day. When you build, I'll do this. And I was like, I could go through the proper channels, or I could just scrape it off Yahoo, because it's the only way to sort of do it and have any kind of model that kind of makes sense, and just hope that I don't get caught. So it's sort of like, I think there's a regulatory moat, and regulatory is not the proper word for it. I don't know what it is, but it is the only thing that sort of protects them. And even with that, in the last 10 years, they've just been pretty ordinary. I've used their software before back in the day. The couple of the companies I work for had it wasn't that special. And I'm probably being very unfair here, but if we were talking about this and this is the PE was 12, okay, you've got my curiosity. PE is 30, right? In an increasingly high interest rate environment for a company that has not grown for a decade, pass.
Yeah. No, fair call. Do you have any other thoughts, Claude? Should we wrap it there?
No, I think that's just it. I think that's Andrew's kind of given us the narrative that I feel is out there. So I think that the story with Iress would be like maybe a small improvement in fundamentals, simplification of the business, strengthening of the balance sheet could then assist a bigger transformation in the actual narrative. And so it would be more about a combination of that the narrative change bringing a little bit of an uplift.
Nice.
I mean, they're running at a 12% net margin already.
Yeah.
So it's sort of like, I'm sure there is some fat to cut, but I mean, if that doesn't, like, whenever you see sustained margins that are, net margins of that magnitude, something's going on there, right? To sort of suggest a competitive advantage. And I just feel as though the root cause of that competitive advantage is tenuous.
You may be right, but the point that I wanted, where it's interesting to me is we've got a few of these high quality or these high margin growing software companies on the ASX, and they seem to benefit from like these flows from, I guess, like superannuation funds or whatever I think we've speculated about in the past, which just allows them to maintain these like really high PE ratios. And Iress isn't getting those flows because it's not considered a high quality software company. But if it did get even some of those flows, then you can start getting kind of a silly multiple. And even if that doesn't last very long, that if you sort of bought it and then sold it into that silliness, you probably do pretty well. But obviously that's just, I'm just outlining what I think is an interesting idea. No position in it myself.
Yeah, no, I'm glad you brought. I mean, you said before that I'd followed it before, but prior to the previous 10 years, I mean, they'd had an incredible history of growth and share price appreciation. I mean, fundamentally back share price appreciation. There was a lot to like about it. I just think it's been
this diversification, right? They took a write down on their UK expansion. Like how many times have we heard something like that?
Gosh,
whether it's the UK, it's almost always the UK or the US, isn't it?
Yeah. Or China.
Yeah.
Especially China.
The whole company is now embroiled in a fraud case, and our executive is in jail.
Oh man, sorry, Matt. I know you're trying to wrap.
No, it's good. It's good. Covered quite a bit in the end. All right, guys. Well, let's wrap it there. If anyone has any other thoughts for what to chat about next week, hit us up on Twitter at BabyGiantsPod. Until next time, thanks very much for listening.
Thanks, everyone. Have a great day.
Yeah, cheers.
My favorite Joe Rogan memes was I can't remember who put it now. It was on Twitter. It is basically like, Joe Rogan, a 5-year-old told me that, just cut this out, Matt.
All right, cool.